Has Brexit ruined your pension? That was the rather terrifying question I was asked during a City Aim podcast recently. Now, before you panic, the answer is probably not. But the flight to UK government gilts and the potential for an economic downturn, expected by many experts but by no means a given, could affect your pension plans. Hi, I'm Tom Selby, AJ Bell's Senior Analyst, and for the next few minutes I'm going to explain what this means for annuities, how your drawdown investments could be affected, and why long-term planning remains the key to securing the retirement you want. So let's kick off with annuities. They're insurance contracts that pay you a guaranteed income in retirement. The initial reaction of financial markets to the Leave vote has followed the path predicted by most economists. So that means sterling's plummeted, while demand for UK government gilts has surged, meaning the yield or interest rate these gilts pay has fallen to record lows. You can see what has happened to gilts in the chart to my left. This matters if you're approaching retirement because insurers use gilts to pay annuities to savers. So when yields drop, annuity rates usually follow suit, and we've already seen a number of insurers reduce rates in the wake of the shock Brexit vote. Rate cuts will inevitably cause those who are considering buying an annuity to pause for thought. However, if you don't want to take any investment risk at all and require a guaranteed income to pay for your retirement, they remain a viable option for you to consider. Equally, the primary weaknesses of annuities, namely that they're inflexible and rates have hit record lows, mean many will want to consider alternative options in a search for a sustainable retirement income. So should you then turn to the stock market to boost your pension pot? Well, unfortunately, there are no free lunches here. So while those wanting to buy an annuity face a stiff challenge, as we said before, in the face of economic headwinds, drawdown investors face an equally troubling conundrum. As I mentioned earlier, the risk-free rate on government papers plunged in the wake of the referendum, with the Bank of England also indicating it could cut the base rate from 0.5%, raising the prospect of investors being charged to store cash. The search for yield really does not get any easier for investors. Drawdown investors also face a potential problem if, as many expect, markets tumble over the next 12 months. This is because investment losses in the early years of retirement are more difficult to recover. If we take a simple example, assume a 65-year-old with a 100-grand pot begins drawing her income. In year one, markets tumble and a pot loses 20% of its value, so it's now worth 80 grand. If the year after markets recover and a pot increases in value by 20%, it'll be worth 96 grand, still 4 grand short of its original value, and that's before we've even factored in any income withdrawals. So a series of years of poor performance in the early years of drawdown can therefore do serious damage to your retirement plans. Now, if all this makes you feel like giving up hope, please don't. Stock markets rise and stock markets fall, as do interest rates and gilt yields. The short-term uncertainty we're currently experiencing just hammers home the importance of having a diversified retirement portfolio that suits your needs, based on the risks you're willing to take to generate an income. The beauty of investing is that you can buy stocks around the globe or pay a fund manager to do it for you. So you shouldn't be hostage to the fortunes of one country or one region. Furthermore, this difficult investment environment makes it even more critical investors concentrate on what they have control over, that being how much is paid in through tax-efficient savings vehicles and the price that you pay. So that's it from me. Thank you very much for watching, and I'll see you again next time.